Okay everyone, just wanted to make a video on just really the basics of auction market theory, which is what I trade. I do not trade market profile, it is not an indicator. Also, enlarge the video because this will be in HD. So what do I have for you right here? I have for you a balance area. And this is what you see on a profile. You usually see these bulges each day. Something like that. But on a bar chart, what does this look like? It looks something like this. You know, we have these market running higher and then it coming down, trading around here, 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 whatever, coming down here, 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 here. All this shows is that these are unfair lows, which is shown by low volume, and these are unfair highs, shown by low volume. And then there's a point in the usually near the middle where there's a lot of volume. And the trick to this is taking the right trades at the right points, which are the high and low volume areas. So let's just go to present day market. You're looking at the Russell 2000. Now how is this shown on a bar chart? You can see it right here, a balance area. You can see we have unfair highs here and unfair lows here, and we have a lot of volume traded in the middle. And we will show that by putting on a little profile right here. We have unfair highs and unfair lows and a bulge of volume in the middle. Now the trick is trading at the extremes, which are the 95s in this case and the 93s in this case. And when you trade at these extremes, your risk to reward increases greatly. And you will also be able to find key areas on the profile, which are shown by single prints. Selling tails, buying tails. Here's another selling tail, and then the high volume nodes and the highs of days and stuff like that. So I'm just gonna go over an example trade I made in oil today. I entered it right over here. So let's just go through an overview of what was going through my mind in this trade. We knew we had balance here. We had an unfair high and an unfair low. So you want to be taking trades in and around these areas. Let's extend this a bit. It began to break out and we built value lower. That means that the market is officially in a downtrend. Once that was broken and we built value higher, and we got accepted back into this value area, which means that there is a buyer stepping in as prices went lower. Usually when a market breaks out one way, fails, and gets accepted back into the volume, it's going to go to the other side. And that's just a known fact. And that's kind of what I was playing. So what I did was I used the big profile, which is this one right here. And what I did was I took a trade at the extreme of it, but also at the extreme of a smaller one. And what I'm going to do is I'm going to take the trade at the extreme of the smaller one and have the risk of that, but the reward of the big one, which is right here. So going into the types of trades, there are two types of trades you can make. Responsive, which is buying this end of the profile, or selling this high, so you're going against the trend, or being initiative, which is selling the break and buying the break of the other side. What I was doing was I was buying the responsive trade in this profile with the risk of it, and I was also buying kind of an initiative / responsive trade because I was looking for it to go initiative here, but I was buying against the overall downtrend. So remember this, I had the risk of about 15 cents or $150, but I had the reward of potentially 500, 1,000, and it goes on. Really, your minimum target is the high volume node of the profile, so your minimum target was 800. That's about 5 to 1. So that means you could have four losing trades in a row and have one winning trade, which will put you on the winning scale. That takes a lot of emotion out of trading. I'll give another example. In gold here, I bought, and really this is a real trade, and I still have it marked actually. You can see this red line I drew right there. I bought this right here. And I didn't have to be a magician to do that. All I knew was that we had an unfair high here and an unfair low here. Gold was overall in an uptrend, which you could see by value building higher. So you want to be a buyer either way, either the break of this or a buyer down here. All I had was a stop down here of about $100, 1 point, but my potential reward was 60 to 69, which is about 500 and higher. A lot of traders, they trade in these random areas, and that's what gets them killed. The risk to reward in these random areas are terrible. They're usually 1-to-1 or even worse. But when you're trading at extremes here and here, the risk to reward increases, and that's what really auction market theory is about. So let's go back to this again and go over the trades you can make. You can either take the responsive trade. Oh shoot, let's use this. The responsive trade, which is the sell here or the buy here. Or you could take the initiative trade, which is the buy up here and the sell down here. Or breakout trades. Your stops for breakout trades are usually just above the low volume. Here. And for responsive trades, just above the high. Here or there. But your potentials is for the initiative trade is the length of this profile in that direction, or responsive, the length of the profile in that direction when taking it at the lower extreme, and vice versa for the top extreme. The ideal trade in auction market theory are the ones where, let's say you buy it at this X that I'm drawing right here, where you first have it as responsive, but the market continues to go higher, and where it breaks out and turns initiative. Those are the trades that are going to make your account explode literally by 20%. And same on the other side, where you short it near the high and you have a break low. Like, think about it. Let's say your goal is to catch the high of the day. You could try 4 times at, let's say in gold, at this extreme. Let's say this was the extreme, it stops you out. Try it again here, it stops you out. You try it again here, it stops you out. Try it again here. You've probably accumulated, 3 losses of maybe $120. So that's a good, $360 to $400. But one trade is gonna make that all back. And think about it. When you're entering short here, you're gonna hold in until something says get out, and that is indicated by a bounce area forming higher. So you could see balance kept forming lower. Nothing was saying sell until this thing broke right here. So you want to be taking it off in and around this area. So that's how much? 1,200 when you lost 400. So you're up 800, and that's how you make your money. You're gonna have more losing trades in the beginning, and then big winners that wipe it all out and give you a lot more money in return. And once you increase your knowledge about the market and your feel, you'll be getting more winners, and that's gonna increase your profits even more. So that's the key, really the key to trading properly. Like, in the long run, you're not going to make money risking 50 to make 50. You have to be risking less than you make. A regular trade you're going to get is ones where you risk 50 to make 250, and then you will find some where you risk 50 to make 1,000. And those are the trades that are going to make your day. So thank you for watching this video. All my videos will now be in HD. Thank you.